Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
25 basis point rate hike today is set to be upstaged by policymakers in median dots, along with any changes to the accommodative language of their August 1st statement, according to strategists and economists. The rise in the Fed funds rate target to 2 to 2.25% seen as a given. Policymakers may neutralize forward guidance in their September 26 statement, display a firm intent to hike in December. The odds of an additional December hike after September move were 80% based on YS pricing Monday. More increases priced in for next year in June. The Fed penciled in 3 hikes for 2019 and 4 total for this year. The key question today is whether the Fed will be prepared to keep hiking past the neutral level for rates. There could be no incremental clarity on the issue at this meeting.
All right, and let everybody kind of filter in here.
Just picking up on a note from Barclays, Fed is likely to again convey that the economy is doing well and gradually will see in the expansion higher in the dots for the next couple of years, even as the long run dots.
Okay. Twitch should be fixed now. He moved it up? What? Okay. So what's been going on? I haven't been watching all of the action super closely because I have been working. Trying to fix my VPN. But what's going on here is a huge offer. It was about 2,000 contracts showed up in the 30-year, and we started moving up towards it. When we got to 07, there was a big iceberg. We observed 2,000 contracts in 07, which is quite a lot. Also, a pretty big order showed up at 18.5. Now, since that time, it does look like people are closing their orders. So, yeah. There is a big order. It's not, I'm not sure if it's the same big one, but there is a big order up at 140.10. So we could get that. I am seeing a little bit of a spread trade here. So if they were buying the 30 and selling the 10, that would be a flattener, and a flattener here in this location would make sense. You can see from my 10-year chart with the flattener on here, we're right up against some resistance levels in the knob spread. So this would be a good place to put a flattener on. And if that is the case, then chances are we're going to see some selling. Now, it may do nothing. I don't know if this action earlier was somebody saying that they know what's going to happen or what. But, yeah. I think there is a good chance that we could see sell, and we could maybe do this. Right. So that's kind of what I'm looking for. But we kind of can see, a lot could happen in the next 10 minutes. And here in 2 minutes, you're going to get the big pull. So there was already a little bit pulled off 30 minutes ago. You can see it here on the Vista, right? About how actually that was not the right spot. It was right. But definitely now they're definitely pulling off, so. Bum 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 ba-dum. My ear hurts a little bit. I think I might need to drink a bit more. Still a lot going on with the Kavanaugh stuff.
In the Canadian dollar. News that the National Energy Board is to hold a public hearing on Trans Mountain reconsideration.
New allegations. It seems like a lot of people on the right believe that their new allegations are just ridiculous,
10 minutes now.
not credible.
Interest rate decision for this month. Picking up on a note now for Goldman saying automotive likely calls and no Fed minutes instead removing the word would at some point fairly soon be appropriate. Implication of leaving it in hikes will be bullish for the assets. The reason that the Goldman believes it will stay is that forecast for the slightly higher than by hiking will be low. These things will ultimately be removed at the December meeting now. Like this year, I don't believe it should matter, but say it will be a focus.
Trump tweeted about it, but I'm not seeing it in my tweet deck for some reason. They have come back quite a bit from the highs, that it's for sure. Good for ticks there. And the big offer at 18 is gone. So just want to make a note here and here. Okay, yeah, I do see now somebody on the Twitch, so I think we fixed the Twitch. You're hearing an echo. Okay. Nah, that's kind of weird. So, Chris, are you still having issues? I am still getting a little bit of OBS saying that my stream settings are a bit too high. So, I don't know why it says that. Like it's there and then it disappears and then it's fine again. I think it was doing it. Okay, so it's okay now. I might need to turn some of my settings down. I was maybe making it a little too high quality. Or were you saying that the issues you were having before was from the Twitch? So let's just pull this up for a second. Let's see if I can. I don't know. See, it's fine when When I pull it up, I think we're okay now. I don't know what I was doing before, but I think we're okay now. Yeah, audio stream is going and then the video catches up, but the video has a second audio stream that's in sync with the video. Okay. So maybe the machine is having trouble encoding for a few seconds, and that's what's causing the lag. They're really pulled now. When it gets into the event, it's often like not even 100 contracts, so we got the squawk set up.
Comments now from President Trump saying we have agreed today to start trade negotiations between the US and Japan. Just over 3 minutes now until we get the Fed's interest rate decision. Picking up on a final note now from TD Securities, are expecting, along with everyone else, a 25 basis point hike. They expect the language to be shifted from the stance of monetary policy remaining accommodative. We are remaining somewhat accommodative. As for the trade, their baseline is for the US dollar buying on the headlines, but say that may present opportunities, given that the market is leaning towards a hawkish reaction, according to recent Fed speeches and elevated positioning in the dollar. I think the Fed maintains the accommodative language and delivers a rate hike, which they priced in now. That leaves a possible asymmetric response in the FX markets, where the dollar weakens more than doubles take and rallies. If the market takes the dollar higher on the baseline, it offers attractive risk rewards to the euro. It's more from Trump saying he's sure that US and Japan talks will have a satisfactory conclusion.
44,000 orders at the ask. I don't know. There are most certainly some big guys taking some trades here, though.
It's more from Trump saying trade deal will be good for both countries. One minute.
All right. So they are pushing up again.
10 seconds.
Okay, there's a pull.
The hike by 25 basis points. That's removing from the statement the description of monetary policy as remaining accommodative, seeing more and more rate hike this year and 3 in 2019, faster economic growth this year and slightly faster growth next year in new economic projections compared with June projections.
Okay, they're still buying.
Inflation in 2019 compared with prior projections for 2019, core PCE in 2019, unemployment rate unchanged. And the statement does not change the description of the economy, repeating that jobs gains have been strong and household spending and business fixed investment have grown strongly. It repeats expects further gradual increases in Fed funds rate will be consistent with sustained economic expansion, strong job markets and inflation objective, repeating the risks to the economy appear roughly balanced. It sees its interest rate paid on excess reserves at 2.2%, keeping it 5 basis points below top of the Fed funds target
Dots
range.
show 12 of 16 officials favor 4 rate hikes in 2018.
So again, just recap that from the Fed. The dots showing that 12 of 16 officials favor 4 rate hikes in 2018. It raises its rates
I'm
by
faster
25
than you
basis points,
are.
removing the reference to accommodative policy in its statement.
I think removing the reference to accommodative policy is significant, right? Seeing that big old order at 19.5 makes me a little suspicious. Because I've seen this before. So obviously information is still filtering, and I want to see the statement changes. Okay. So the committee decided to raise the target rate. Blah, 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 blah. And I don't even see... Oh. The stance of the monetary policy remains accommodative, thereby supporting strong labor market conditions and a sustained return to... Okay, so they got rid of that. That's bearish, and the plots are 4 of them. So I am a little confused why they are buying it.
The end of 2018 was 2.375%. The end of 2019, 3.125%, again unchanged. End of 2020, unchanged as well. The 2021 3.375, longer run 3% was a prior of 2.875%. The medium forecast of Fed policymakers is for 1 more rate hike in 2018 for a total of 4, seeing a 3 in 2019, 1 in 2020, and none in 2021. GDP growth of 1.8% unchanged, jobs rate 4.5% unchanged, and PCE price index 2% unchanged.
See, the amount of buying that we're actually seeing coming in through here in relation to the rest of the day is not that much. The buying looks suspicious to me, personally. That's just me. You notice this big order here is still there. Oh, it is lunchtime. Do you hear that? Okay, they just hit through a pretty big offer there. They're still steepening. Gold went up quite a bit there. Oh, whoops, wrong button. Updated economic predictions. Real GDP. They're still looking at under 3% still. So that's not good. Okay, so now I'm seeing that 8. See this big guy right here in the 5-year? Okay. Set that 22, please. Okay, the big order that was there in the 5-year is gone. And we're seeing a lot of short volume coming in. Well, now it's getting slow here. It's kind of interesting. I think you're going to continue to see some profit taking, and that 22 is not pulling out of the way. There you go. Okay, there we go. Thank you. Okay, now there's big at 13.5. Not really hitting into that. Now it's gone. Now it's gone. Now it's in the 5. Now it's in the 10-year. Oh, they're fucking around with us today. Well, that 13.5 is not breaking. Is there going to be an iceberg there? Okay. There is a little bit. 2,000 sounds about right. Yeah, okay, that was a pretty strong uptick. That really hurt our case. It doesn't tick back down immediately. Yeah, okay. That sucks because it was at almost 4+4 at one point.
Just following the announcement from the Fed, the funds futures indicating that the market is close to fully pricing one more rate hike at the end of 20 Fed rate. January 29th Fed funds contract is trading at 97.63, applying a rate of 2.37%. 29th, the hike fully priced in, indicating the market is pricing in another move at or before the Fed.
Okay, so this link right here I'm posting in Discord seems very insightful. So they're saying that because they're no longer accommodative, quote unquote, that is not necessarily hawkish. It means that they're getting close to the target rate, and that means that the rate of rate increases will subside. So I took that initial one at 22.5, right? We'd still be sitting on the doorstep of it.
This is a bit of metals news now. Fitch, the trade is driving copper price volatility. Labor concerns subsiding.
Well, it looks pretty calm here now. Alligator took a few in the 5 here. So here's where it's really hard to tell if this is just a pullback or if it's reversed now. Or which way it's going to go. I don't know if this is a good spot to take a trade. Well, that was a pretty good downtick. I like that they're hitting into 21. When now they're really crushing some of those bids. Should have held it. Now right there would have been +4 would have been an okay profit place to take profits there, I think. E-mini seems to be going higher. So they like it. Like when I look at the dot plot, it looks hawkish to me. Oh, what do I know? Bum bum bum. See that action right there? The pressure's not really following through yet, so it could break, but from an order flow perspective, I think that if I had been kept on my short, I would need to be getting out here and bail at +4.
So following the Fed's decision to hike its rate by 25 basis points, 10 minutes now until we're expected to hear from Fed Chair Powell. RBC saying that Powell's press conference expecting his comments to reflect growing upside risks to the backdrop. Tariffs are downside risks. Again, we have posted a link onto our board and Twitter page to watch the press event live. Just be aware to your new listeners that we won't be squawking during the Powell press conference. Anything point up. And we have given a premium dial-in for our premium listeners. It's a bit of banking news now. JP Morgan will be increasing its prime rate 25 basis points to 5.25%, be effective on September 27th. Seeing a move higher now in the E-minis to around 29.33. Equity news now from Amazon has discussed building proprietary video ad serving product for business and eventually licensing it. Business Insider. In comments now from Prime Minister May, Brexit vote was not rejection of multilateralism and for accountability. Also from the US Defense Secretary Mattis has indications that Iran is intending to block the Strait of Hormuz. It's under 3 minutes time now, so we're expecting Powell to start the press conference. Initial reaction from TD Securities, the median dots are unchanged for 2018-2020, but the distribution has drifted higher. The 2021 dots indicating an end to the rate hike cycle, with some Fed officials penciling in cuts. Policy stance is no longer accommodative, as such markets have taken a dovish cue. Powell's comments on risks, emphasis on fiscal stimulus and tight labour markets versus tariffs, and overshooting will be watched. Says Powell is taking on to the stage now. A reminder that we won't be squawking during Powell's press conference unless other major news hits. We have posted a link onto our board and Twitter page as well as our premium list.
That's interesting. They've got classical music on the stream for the Federal Reserve this time. Was that there last time? I don't remember. Well, he's talking now. He's going to talk, so I'm going to probably mute myself. I don't think I'm going to take any more trades. The way that it comes, they viewed it as dovish.
Good afternoon, everyone. Thanks for being here.
Bring him down a little bit. They viewed it as dovish. It came up here and then it came back. I took the right trade, but now it's back to balance and basically where it was before the meeting. I don't think I want to mess with it.
Inflation is low and stable. All of these are very good signs. Of course, that's not to say that everything is perfect. The benefits of this strong economy have not reached all Americans. Many of our country's economic challenges are beyond the scope of the Fed, but my colleagues and I are doing all we can to keep the economy strong, healthy, and moving forward. That is the best way we can promote an environment in which every American has the opportunity to succeed. Each time my colleagues and I meet, we face the same question. How can we set policy to best support job growth and low, steady inflation? For many years, this question called for very low interest rates to help an economy that had been damaged by the deep financial crisis that gripped the world 10 years ago. As the economy has steadily gained strength, the Fed has been gradually returning interest rates closer to levels that are normal in a healthy economy. We took another step on that path today with a quarter-point increase in short-term interest rates. These rates remain low, and my colleagues and I believe that this gradual return to normal is helping to sustain this strong economy for the longer-run benefit of all Americans. As I mentioned, 10 years have now passed since the depths of the financial crisis, a painful part of our history that cost many Americans their jobs, their homes, and for some, their hopes and dreams. In addition to holding interest rates low to support the recovery, we have also taken many steps to make the financial system safer. In particular, we're holding the largest banks to much higher standards in the amount of capital and liquidity they hold and in the ways they assess and manage the risks they take. I'm confident that the system today is stronger and in a far better position to support the financial needs of households and businesses through good times and bad. We continue to work to sustain these fundamental improvements while also ensuring that regulation is both effective and efficient. Now let me go into more detail about the developments that motivated today's policy decision. Both household spending and business investment are expanding briskly, and the overall growth outlook remains favorable. Several factors support this assessment. Fiscal policy is boosting the economy. Ongoing job gains are raising incomes and confidence, and overall financial conditions remain accommodative. These conditions are consistent with our summary of economic projections for this meeting. The median of committee participants' projections for the growth of real GDP is 3.1% this year and 2.5% next year. Job gains averaged 185,000 per month over the last 3 months, well above the pace needed in the longer run to provide jobs for new entrants to the labor force. The unemployment rate stood at 3.9% in August and has been near that level since April. Smoothing through month-to-month variations, the labor force participation rate remains about where it was in late 2013, a positive sign given that the aging of our population is putting downward pressure on participation. We expect the job market to remain strong, and the median of committee participants' projections for the unemployment rate later this year is 3.7% and a bit lower than that in 2019. Overall consumer prices, as measured by the Price Index for Personal Consumption Expenditures, PCE inflation, increased 2.3% over the 12 months ending in July. Core Price Index, which excludes the prices of energy and food and tends to be a better indicator of future inflation, rose 2% over the same period. The FOMC seeks and expects to see inflation remaining near our 2% longer run objective on a sustained basis. At any given time, inflation may be somewhat above or below 2%. For example, the recent rise in oil prices has pushed inflation a little above 2%, but we expect this to be transitory as is reflected in our projections. The median projections for both the overall and core inflation measures remain very close to 2% across the whole projection horizon. Today, the committee raised the target range for the federal funds rate by a 0.25 percentage point, bringing it to 2 to 2.25%. This action reflects the strength we see in the economy and is one more step in the process that we began almost 3 years ago of gradually returning interest rates to more normal levels. Looking ahead, today's projections show gradual interest rate increases continuing roughly as foreseen in the median of participants' views on appropriate policy through 2020 are unchanged since the June meeting. These projections play an important role in our work. My colleagues and I believe that it's useful to communicate our views on likely prospects for the economy and for policy. We are well aware, however, that the economy regularly surprises and that even the most carefully constructed projections are highly uncertain. The projections about the appropriate path of policy assume that the economy evolves broadly in line with the projections for growth, employment, unemployment, and inflation. If the economy were instead to falter, lower interest rates would be appropriate. Conversely, if inflationary pressures were to rise more than expected, higher interest rates would be appropriate. Right now, as our statement indicates, risks to the economic outlook appear roughly balanced. Readers of the FOMC statement likely noted that the committee dropped a sentence that indicated that the stance of monetary policy remains accommodative. This change does not signal any change in the likely path of policy. Instead, it is a sign that policy is proceeding in line with our expectations. We still expect, as our statement says, further gradual increases in the target.
There it is.
And this expectation is reflected in the projections that I just discussed. Thanks very much. I'm happy to take your questions.
Thank you. Nick Timmeros, The Wall Street Journal. Chair Powell, the legs of monetary.
We're now negative delta.
So the tightening cycle, as you know, is a reflection of the strength of the economy. It's almost 3 years now that we've been gradually raising rates. I think the fact that we have moved quite gradually, in a way, allows us to carefully watch incoming data.
Removal of accommodative instatement is a sign that monetary policy is proceeding in line with expectations. So doesn't that... Why did they sell it on that? The way the market's reacting to this is not...
Being able to raise rates and then wait and see how the economy
I'm not seeming to understand, so...
has performed very well and very much in keeping with our expectations.
President Trump has stated publicly comments didn't appear to have any impact on colleagues.
It's hard to make a trade here because, well, I mean, if you were going to do something, I think the risk-reward favors buying it here. But
we've been given a really important job to do on behalf of the American people by Congress, and we've been given the tools to do it. And my colleagues and I are exclusively on carrying out that work. We consider the best thinking, the best theory, and the best evidence. We have disparate points of view, we debate extensively, and come to a perspective and try to set monetary policy to maximum employment in the context of prices. That's what we do. We don't consider political factors, things like that. And so that's who we are, that's what we do, and that's just the way it's always going to be.
Policeman CNBC. Thank you, Mr. Chairman. Can you explain how stock market being at an all-time high, corporate spreads being very tight, how does the level of the market factor in your decision to raise interest rates? Is there a concern on your part? And then, as sort of a second and related part, can you tell us what happens in 2020 and 2021 that I know you can't tell us? That prompts you the Fed to think that the rates will be above neutral.
Sure. So in terms of financial markets and monetary policy, we, as we say in our statement,
so you could still buy it here.
We do take financial conditions into consideration because financial conditions do affect the broader economy, and they're one of the many things that we take into account. The part of it that we control, though, is what we do with the federal funds rate, and that has effects out through the full interest rate curve and into financial asset prices generally. So the answer is we take everything into account, but and broader financial conditions are just one of the things that we take.
Okay, maybe they're going to keep going now.
In terms of 20 and 21, your question was why the funds rate needs to be above neutral. So you're right. Some of the participants have mostly very modest overshoots of their personal estimates of neutral, a couple 3 years out. It's far out into the future. I think it's hard to be confident that that's the way things are going to be. What we're going to be doing as we go through time is asking at every meeting whether monetary policy is set to achieve our goals. And I think that's an assessment of where policy will need to be some years down the road. And leave it at that.
It's kind of hard to watch. It's kind of hard to watch what it's doing here because I would, I kind of thought, hey, maybe I could sell it at 18 and pick it up at 14 if there was like an impulsive move after it. So to see it here at 18 now kind of makes me think, well, maybe we should be selling it, especially since the overall delta is negative. And my reading of it was that this is still hawkish overall. Moving off of that statement that he made, I don't know, like just the whole thing kind of seems to me like, yeah, maybe you could make a lot of money, but I'm just not sure enough to take it. So I don't know, woulda, coulda, shoulda, but I think that it's probably better to watch it on my side and not take the risk, because he could say something that it just as easily pushes it back up. Well, now there's that 1600. That's actually worth taking a trade on. After I say all of that, I'm probably not going to get it.
Strongly anchored inflation. That's not just our forecast. That's many forecasts. That is the forecast. So you may ask, I mean, in a sense is, what does the longer run natural rate of unemployment mean? And so that really is a longer run concept that we think the economy will return to over the longer run. But obviously that longer run isn't not creating problems in the short run for the forecast. Now, let's just admit that the inflation process changed dramatically from where it is now. It's in a good place. Can't take for granted that we will be, of course, watching carefully. Reacts more strongly or more weakly to this strong economy, then we'll adjust policy appropriately. Well, rates.
Okay, well, we missed that one.
Growth have effect. I guess your question was, what are you buying with by raising interest rates? The question is, what would the economy look like if it didn't raise? It would look very different, I think. We're always trying to, work our way between.
So I don't like the way they're hitting into that.
The two problems. One is that if we quickly snuff out a recovery unnecessarily, inflation fall on target, or if we move too slowly, we have an economy that can overheat. That's happened through history. We don't see any signs of that now, but we're always trying to navigate goals. We think that
they just went down to the opening range low and bouncing off of it. I don't know.
Thanks very much. Sam Fleming from the Financial Times. The Fed has recently been saying that moderate of developments could prompt a change in investment, elevated risks. And is there an argument for moving a typical capital buffer when risks are moderate, rather than waiting until the risks are seen as elevated, which arguably
one of the most important lessons from the financial crisis is really the importance of the stability of the financial system. So since the financial crisis, where we've major focus on building up, monitoring financial stability. We've also in place many strengthen the higher capital and better regulation, more transparency, central clearing, margins, all kinds of things like that, which are meant to strengthen the on many of those things. We feel that the financial system is a much better place. As we look at conditions most recently, meeting and it's for the quarterly, we have a briefing at the FOMC board of staff's views, and the staff judge the overall vulnerabilities to be moderate. If you dig into the different aspects of that question, households or balance sheets are in good shape, employment is the banking system, higher capital, much higher liquidity, much stronger. If you look at asset prices, it is true that some asset prices are and then look at non-financial corporate.
I mean, 18.5 is a place you could potentially take a short.
Any vulnerabilities, but we see them as moderate. You ask about the
market news now. Comments from the Turkish President Erdogan running in the fast newspaper. US government's irresponsible policies are pushing the world towards a reckless trade war. And Turkey must unite to prevent a destructible trade war. Turkey expects Germany to support its fight against the Turkish
we
group
revisit that on a regular schedule.
Movement.
And the last time we revisited last year, as I mentioned at the last briefing, and as we feel. As I said, I think I'm in the camp of seeing vulnerabilities as relatively moderate. I think the financial system. I think another thing that we learned in the crisis, be alert to the buildup
Yeah, buyers are a little more jumpy now.
of long expansion. I don't see that in troubling amount. Appropriate.
Researchers out a paper saying that the act of a trade war on the U.S. dire that by widespread trade war. Could you talk about what discussion you've had? Your policy statement doesn't mention the trade tension. Not mention what kind of outlook are you have right now?
Okay.
Trade war.
Lizzie, take
So
up,
I guess I
please.
need to start by saying that I'm not responsible for trade policy. Don't comment on particular trade action, sort of thing.
Okay.
But we'll have seen have this very
My target is in the right spot, so I'm going to leave it.
around the country, reserve banks largely. We've been hearing a rising chorus of concerns from businesses all over the country about disruption of supply chains, materials costs, and loss of
Did not like that.
So we've been hearing quite a lot of that. And
Okay, that's
reserve
good.
bank presidents talk about it in the meeting, and it goes in the minutes. So we're very transparent about hearing all that. I think if you look at the aggregate the performance of the U.S. economy aggregate at a national level, hard to see much happening at this point. You can look at it the other way. You can ask if all of the tariffs that have been are applied, what would be the effect at the aggregate level? They're still relatively small. We worry about a couple of things. One is business confidence with investment. We don't really see effects that we. Also, the possibility of a financial market.
Suck.
More than anything, though.
I mean, that was a good trade, but I just was not able to catch it out.
If the end place we get to is lower trade, that would be good. Trade generally supports productivity, supports higher incomes. Fair trade under nationally accepted rules can be a good thing. I think if this perhaps inadvertently goes to a place where we have widespread tariffs that remain time more protectionist world, that's going to be bad for the workers and families, also for other economies.
Other law. This is the third time. I'm wondering if you about what's causing that rise and whether you apply side effects coming through policy.
It's true. This year, as we've kept raising our forecast for the year, as the year's gone on, the economy has come in stronger than we expected, and that's a really good thing.
So I still see some buying it in here, but I'm concerned with what I'm seeing in the 5-year.
There's good reason to expect that to continue. You ask why? Some of it is no doubt the effect of fiscal policy changes, the tax cuts, and the spending increase. That's got to be part of the story. Part of it may be higher oil prices, which are calling for investment and catch. But the growth picture is very much supported by very high reading household confidence. It's a pretty particularly bright moment. Look back over the last decade, this is a pretty good moment for the U.S. Oh, supply side effects, yeah. So we hope they're huge, frankly. The idea is you cut reduce taxation on corporations, particularly allow faster expensing for investment. The idea is to encourage investment at one of the things that drives productivity, which is the main things that drives rising incomes. So effects are very uncertain. The literature, there's no clear answer to exactly how these mechanisms work or how. And it would be potential growth.
Craig Torres from taking a page from your approach in Jackson Hole. Wondering if you can talk about what risks, plausible risks, go faster and what risks would make them slower. Talk about. And then I'd like to ask yourself as the stimulus tails off, which it does in the forecast, possibly cutting rates to off-land economy. I know the forecast doesn't show that, but
I mentioned the main thing don't see that not in our forecast. For significant correction and lasting or a slowing down. In terms of what what we would do, we're always going to, in light of conditions on the economy's weakening, cutting rate, vice versa. Can't rule that out. I think it's quite difficult what the effects, what sort of end effects of fiscal policy, difficult policy. You have to make estimates.
Fox Business. Thank you, Chairman. The unemployment rate's now the 9%. Inflation, according to your numbers, steady. The amount of job vacancies we have out there and the number.
Well, there would be my fill, I think.
Where is the point
Not quite.
actually above the national? And the Federal Reserve should rate hikes go.
You mean where's the point at which unemployment is too low? Yeah. So we've been, I think, the labor force participation surprised us on the upside. There is a long run trend there. Now had basically 5 flat.
Okay, there's the fill. So I could have gotten +4 on that. I could have done well on both of my trades, but
oscillation, basically sideways move. In the face of a significant.
I guess I just need to hang on a little bit longer.
That's a gain of well more than a percentage point. That's really a good thing. Those are people who are remaining in contact with the labor, looking for jobs, finding jobs. So that's a great thing. And by the way, it's a signal. One of the things that has allowed the employment rate not to fall further. It's a signal too that there may be more there on the supply side. There may be more labor.
Gold is all over the place.
Trend would indicate.
I wouldn't want to be a gold trader.
To see staying in the labor. We don't know how long it will continue. We have models and look at this question all the time. And admittedly, we've been surprised on the positives. Open to the idea that may continue, or not.
Donna Borak with CNN. Just to follow up on the tariff question, you said earlier that it seems as the effects of the tariffs so far haven't quite materialized. Those weren't
Okay.
But Walmart, Gap, Coca-Cola, General Motors, Macy's have all said that they expect the price. My question is when should there be an effect? When would we expect to see that? And dampening economic.
It's a concern. It's a risk.
So that's a good sign right there.
Prices move. You don't see it yet, but you could see retail prices move. The tariffs might provide a basis for companies to raise prices. A world where they've been very reluctant to and unable to raise. Raising prices is really difficult. Up on the internet. This could provide a way for. Again, we don't see it in the numbers. Until we see it in the numbers, hard to say how one would react. And the other question would, talking about the effect on inflation, is it just a one-time increase in the price level, or is it fueling higher inflation going forward? And that's an important question, how we would think appropriate response.
Timing in terms of when you might.
Okay, now that ZB is picking up a strong bid.
Don't see, but you're hearing, I mean, broadly across the economy, it's not just tariffs. We're hearing a lot of talk of labor shortages, of material costs in particular, bring a lot, what amount to.
I mean, it's a good bid there, but they're not hitting.
Like that, but not seeing it. We're seeing it. There's sort of modest increase.
I've been really good at talking myself out of trades today, haven't I?
No sense of it moving up, really. Not seeing it, and aren't watching very carefully.
Chairman Michael McKee, Radio and Television. Financial conditions are still extremely loose measures to track that. Flow of funds shows a decline in short-term borrowing of Treasuries. So I'm wondering if that suggests a change in the way Fed tightening the economy. And along those lines, that drop the word accommodative doesn't suggest a, but dropping forward guidance in accommodative, does the dot plot really serve any purpose anymore? If, as you say, confident on what's going to happen with the
questions. So, the dot plot. I mean, it's not new. I don't think it's a new point that forecasts 2 and 3 years out, 2 or 3 years out, are fairly uncertain. Dot plot is individual FOMC participants who are writing down their individual views on the evolution of the economy and of appropriate monetary policy. We don't vote on that. These are individual forecasts. I think market participants generally find that interesting information, and so it seems to me to be serving a purpose. I think the point with accommodative was that its life was over. Put that in the statement in 2015, just when we lifted off, and the idea was to provide assurance that we weren't trying to slow.
I think there's going to be a lot absorbed up here, but I think that they're going to break a new high.
Rates were still going to
be. You're going to break a new high. That they're going to absorb some. If we see some absorption, then I think I can take a short.
The language.
So there's the break.
Say anything important to the way they're thinking about policy. Did I get all of your questions? Yes. Yeah. It's if you look at a broad financial conditions index, that's pretty much that we don't control that. And as I mentioned earlier, we do take financial conditions into account in what we do, and financial conditions are affecting the broader economy. So by definition, taking them. But if you look at interest rates, look at long-term interest rates this year and short-term interest, very significant increase. And with your long and variable lags, that should be having an effect over.
Hey, it is not. They're not absorbing, so this could keep going.
Sorry, agreed it with. So Nellie Lang was, and I was just curious, veteran of Fed, what role recommending him, president put on, and then also if I may follow up on earlier, you've mentioned before that corporate debt is at levels, and I was curious whether you have any qualms about putting up restrictions on leverage by guidance. Yes, while at a time when leverage lending.
Okay, so
there it is.
really decisions. Think of us as just consulted. I will say that I'm very happy and excited about the team that we're putting together. I'm very much looking forward to having the offices up and down build. It's pretty quiet, more quieter than you saying something on the board hall. So we're looking forward to getting some confirmed. In terms of corporate debt, so this is a
So the problem now, if you were short, is where does it stop?
very close.
Okay, I actually am seeing the order right there.
So I have had a lot of experience in that
I
market.
didn't even
is
notice that.
really significant for the crisis, and the banks take much less risk than we do. They're essentially in the business of distributing, keeping them on a much greater degree. But it's also true, significant research that excessive risk taking in the leveraged lending markets does have channels for affecting the real economy, overheating and that kind of thing in the markets. So we monitor that carefully.
There's a chance they could come all the way back to 21, frankly.
Leveraged lending is binding, and the law is interpreted. So it's something we're monitoring.
But there is the big order in CF is right there, and look, they are absorbing. Come on.
The New York Times. If I can come back to accommodative policy, is how close are you to share the view of colleagues that eventually need?
Are we accommodative now? So I think if you look at the dot plot, you'll see that federal funds rate, even after today's move, is below the longer run neutral estimate. Every single participant submits an estimate. So that's why this is the perfect time to take the language out, because
They are absorbing way too much down here, though.
Because by definition that means an accommodative policy. So it wasn't because policy is not accommodative. It is still accommodative. The thinking was more, as I mentioned, it's more that the language has run its useful life. There's another point, though, too, which is we don't want to suggest either that have this precise understanding of where accommodative stops, or suggest that that's a really important point in our thinking. What we're going to be doing, assuming we stay on this path, we're going to be carefully monitoring incoming data from the financial market economy and asking ourselves whether our policy is achieving the goals we want.
I'm not actually selling it anymore.
Maximum employment, stable prices. That's the way we're thinking about it. That does kind of amount to thinking less about one's precise point estimate of the neutral rate. So that's how I think about that.
Restrictive posture government.
Okay.
It's possible. It's very possible. It happens often. And as I mentioned, many of the participants have written that down, and they've written down really modest over to one rate hike kind of wouldn't have a big effect on the economy. I would just say, it really depends on what happens. Depends on
5 years not going for it now.
keep going. You can think of it different ways.
Well,
Maybe
10K is bad.
Maybe we'll be raising our estimate and we'll just go to that. Or maybe we'll keep our neutral rate here and then 1 or 2 rate increases. I think it's very possible. But, ultimately, isn't really the question we're answering. The question we're answering is how do we provide the economy just as it is, not too much, not too little. Sustain the recovery or step.
Greg Robb from MarketWatch. The 10-year anniversary of the bankruptcy of attention.
Okay. That's kind of what I wanted to see. I want to see that 23 be a bit stronger, and we need to start hitting into the 14 in the 5-year, but that is what I wanted to see. So they're still kind of messing with it over there. And an iceberg, they fill the iceberg, but then it ticks back up again. Okay, and more iceberging now in the 10-year.
The risks.
So 3 things there. First thing is the single biggest thing I think that we learned was, mentioned earlier, the importance of maintaining the stability of. So I think if you look back at the way the models worked and the way people thought about risk in the economy, that's what was missing. I think it's not missing anymore. So we put a tremendous focus on that. We raised capital, liquidity, stress tests, which force banks to understand and better manage. Have
Good.
enough capital.
Oh, good, Paul.
Substantial shock that's at least as bad as. And if all that doesn't work, we've got resolution plans, which many cycles have made really substantial progress, more than I had thought likely. So we've done a lot. Nobody's, nobody is, I think, overconfident that we've solved every problem. Now we're going back and kind of taking a hard look at everything, trying to keep at it. So I think those are the really important lessons, and we're determined not to forget them. That's, I think, a risk now, to forget things that we nature over time. I saw the article you're talking about. The question is, Congress take things away, emergency powers from the Fed. So there was sort of a trade.
Okay, 5-year did.
Away our power under Section 13 to provide support to individual non-banks, which are holding companies and other companies. In exchange for that, we got
It's a strong take, and it didn't hold.
Resolution party. Was it a mistake? I don't think there's any Congress to seriously look at changing that. I have real doubts about whether it was wise to take away our crisis tool. I think you put them away and you hope you never certainly strongly oppose efforts to take away more of our. The third thing you mentioned is designation power. So it's really important power. In my mind, it should be used. My thinking, it sparingly. That means, in situations where we have, in principle, you could have another Lehman Brothers come up out of the ground. It's not a bank, and it could be very threatening.
Good.
It could be capable of creating
Very,
systemic
very
risk.
good.
So I think it's a critical power to have. But again, I would tend to use it fairly sparingly.
Credit card rates have jumped. Fed
My
started.
hand is off the mouse.
Mortgage up. What do you say to consumers?
My hand is off the mouse.
Of course, we look at that very carefully, and interest rates are going up across a broad range of consumer borrowing. They would when we raise short-term interest rates. They're still quite low by historical levels. And the thing I'll say is, if you take housing, look at the NAR affordability index. Housing is still more affordable now than it was in the financial crisis. So you're right that the cost of borrowing is going up, but it's going up from what were extraordinarily low levels. It is something that we carefully. Effect on consumer spending is a very important channel through
how to proceed with the joint plan. What are the issues that are preventing a joint developing, and how close are you to a possible joint?
Well, at the Fed, we are, deeply committed to the mission of CRA, which is for banks to provide credit and other banking services in the community serve. And we have also been of the view for some evolution of technology, changes in the nature of banking. It's an appropriate time. It's past an appropriate time. Now is certainly an appropriate time to visit the think about CRA. But we don't want to lose that focus on. Definitely want to see that fundamental purpose of the law. Any of the issues that we had were reflected.
So this has happened to me a couple of times now where it's gone and I've had a good one and kind of maybe wanted to take a profit, or I had the order and it just didn't quite get filled, and then it's come back and I'm scratching it. And every time that I did that, I regretted it. So now this time I'm going to hold it is going to be the time that they're going to screw me over.
Chairman, following up on
neutral.
Well, I do like the way that it's behaving. They are holding a little bit at 23.5. That's
Slightly
good.
lifted 3%, but that's still, I believe, like 125 basis points below where it was 6 years ago. What are the odds that productivity, investment, productivity, labor market, other developments further push up estimate?
A long press conference.
Projected funds rate levels less restrictive than.
So in principle, the starred variables, long-run growth rate of the economy, the rate of interest, the natural rate of employment, don't move quickly. They move very gradually, pinned down by longer-run forces like demographics, funds rate, productivity, its appetite for safe assets, and demographics and other things too. So they move quite slowly through time. I think we all look at them. Those of us who file SEPs will look at that every quarter, and not make a change every quarter, but every now and again make a change. And you're right. We actually, the median ticked up a tenth. It's a tenth we're talking about. So, but still, I think it's a positive thing that, that people could be raising their estimate. The longer run neutral rate and potentially longer run growth rate. Who knows? And maybe reducing their level of the natural rate of unemployment, which has been the trend. It's just that you change those estimates over time. They're informed by incoming data. They don't change a lot, though. So they did. It's interesting that the neutral rate changed quite sharply after the in many different months. It's been slow to recover. I don't expect a dramatic recovery there, but you know, we're so bad at forecasting productivity. It's very hard to know when productivity is going to arrive and what quantity. So I think we have to be humble about how little we really, where these starred value variables there are or are going.
Paul Kieran, thank you. I'd like to just kind of ask again. You mentioned earlier that a gradual pace rate increases act, but what are you going to look? Also mentioned policy operates with a lag. So any kind of specific signposts, maybe we the end of the tightening cycle or up. Secondly, if you worry about the divergence, U.S. markets.
Sure. So, you know, some of the things that we're looking at to tell us whether we're getting close to supply side would be first this job growth slowdown. Slowing down in job growth would be an indicator. You know, an unexpected sharp increase in wages or inflation tell you that you're reaching those points. You know, if headline growth slowed down, so all of those things worth taking into consideration. I think also, though, we've seen sometimes sharp tightening in financial conditions, as we saw at the beginning of 2016, can have a substantial effect pretty quickly on broad and significant tightening. So we would be looking for those things and many other things. So in terms of divergence, yes, so the U.S. economy is, I mentioned, is strong and pretty positive moment. Strong growth, healthy labor
U.S.
market,
political news
inflation
now
right on target,
coming from the
as I mentioned.
OMB.
So,
the Trump administration backs the House tax cuts
we've
2.0
seen
package.
growth abroad, but growth, I think, both in advanced economies and in some emerging economies slowed down a little bit. And in that world, you know, if the U.S. is stronger, then
Again, that's from the U.S.
that's just
Office
part of the
of Management and
context, part of
Budget.
the
It's the Trump
environment.
administration
That
has
could mean a
backed the
higher
House
dollar.
tax
It could
cuts
be,
2.0
it could therefore
package.
mean that some of our demand will wind up.
So they took me out at the break even.
Integrated international economy works. So
Maybe should have had it one tick lower, but
all things that go into
yeah.
thinking about the path of the economy. I would say, you know, we're not responsible.
Clearly not my day.
Treasury is responsible for managing the dollar, but dollar has only partly recovered the decline that it had in 2007. Not as high as it
Genius market. Can you give us an update? Technical. When have you been happy with that? To make
So we've said that we would use our tools, or that the federal funds rate trades within the target range, and the principal tools be in reserves and bottom end reverse repo ability. So we in June, when we raised rates, we only raised the interest on excess reserves by 20 basis points and rate 25, and that moved federal funds sort of back into the range. It worked, and it was successful. The federal funds rate traded in the low 190s, well within the range.
I'm just so fucking pissed right now. It's just done that to me 3 fucking times in a row. I was right, and I didn't give it enough risk, and it came back, and
Fed funds. So we don't see it as a
So I am defeated. I think I'm too pissed now to want to take it again, now that it's back up there. But I read it right.
Signing an $852 billion funding bill that would avert a partial government
Chairman,
shutdown
Courtney Brown
midnight
from
Sunday.
Axios.
Saying we're going to keep the
Last
government
month,
opening.
the CEA outlined a way to calculate growth. Has the Fed looked at that at all?
I wouldn't comment on a CEA paper, and I would imagine they probably wouldn't. I would just say this. So I am familiar with the question and the work. We look at a range of indicators of, and I think the broader the better. You really a perfect wage measure would also include benefits, because a lot of compensation goes up in the form of benefits. I think it's right to choose those broader ones, but they're kind of all telling the same story right now. Look at the principal 4 that we look at. We look at a whole range of wage and benefit cost indicators. They are all now showing wages and benefits around 3% growth, right? Clustered around. And that's a full percentage point higher than it was. That's a good thing. Then the other question is, what about inflation? If you're looking for real wage increase, you've got to ask inflation. And there you have to pick an inflation measure. Some people pick CPI. We, of course, pick personal consumption expenditures, because we think it's a little better measured, it's a little broader, and it tends to run a little bit lower as well.
Comments now from U.S. Trade Representative Lighthizer saying running out of time on calendar trade agreement. Saying starting to negotiate bilateral Japan trade deal.
Wages and benefits running at roughly 3%.
Japan and U.S. trade deal will require congressional approval. Will start process under the TPA fast track authority.
Headline inflation
will be publishing the U.S.-Mexico text at the end of this month. Still time for Canada to join.
And I think we see the temporary increase in headline inflation being a function of oil prices probably, and we expect inflation to go back. We think of that as 2%. That's how we think about it.
Equity news that Citibank following suit, raising its base lending rate to 5.25% from prior 5%, effective Thursday.
I'm with Yahoo Finance. Chair Powell, I want to follow up on something you said actually, Jackson Hole, talking about longer-term structural challenges in the economy, and you mentioned that addressing the federal budget, which is path, becomes thoughts there.
So it doesn't really come up. It's not really our job, and we do monetary policy. We regulate financial institutions, financial stability, that sort of thing. We don't have responsibility for fiscal policy, but in the longer run, fiscal policy will have a significant effect on the economy. So, for that reason, I think my predecessors have commented on fiscal policy, but they've commented on at a high level rather than trying to get involved in particular measures. So, and my plan is to kind of stick to the same approach and stay in our lane. And so I would just say it's no secret. It's been true for a long time that with the with our uniquely expensive healthcare delivery system and the aging of our population. We've been on an unsustainable fiscal path for a long time, and there's no hiding from it. In the end, we will have to face that, and I think the sooner the better. And also, these are good times. These are, this is the economy at nearly full employment or in the range, in the neighborhood of full employment. Interest rates are low. It's a good time to be addressing these. So I put that out there and leave it.
I'm Takeshi Kanami from Nikkei. Thank you for taking my question. I'd like to ask about the emerging market. Think about the monetary policy emerging market countries. And there's a possibility to stop the interest rate hike emerging market.
It's more from Lighthizer expecting a trade talks with Japan to occur in 2 tranches with an early
Sorry, the
harvest
second
from initial
question was?
tranche.
There's a possibility to stop the
To
interest
stop,
rate hike.
okay. All right. We serve a domestic mandate, which is assigned to us by Congress. That is to have maximum employment at stable prices. About half of global GDP is outside the United States, and way more than half of the growth outside the United States and in emerging markets, I should say. And so the performance of the emerging market economies really matters to in carrying out our domestic mandate. I'd also say that a strong U.S. economy where Americans are buying things and economy's growing and that's going to support demand all around the globe. So that's a good thing. Now, we do understand though that when our economy is strong and we're raising rates, that puts upward pressure on interest rates around the world and can affect countries, particularly countries that have significant external dollar borrowing. What we try to do is very transparent about what we're doing and why, and we have been, I believe, also moved quite gradually. So I think been performing well on that front. There are some countries that are undergoing severe stress, a handful of them, but not most emerging market countries. It's a relatively small number, and those particular countries have particular vulnerabilities, which are well known, in the form of budget deficits and significant external dollar borrowings, high inflation. So, again, we'll continue to conduct U.S. monetary policy as transparently as possibly can. That's really the best thing we can do, along with supporting U.S. I think that answers both your questions.
With Agency France Press. You mentioned earlier possible notable correction, come back to the high level of the stock market. Are there any participants to the FOMC think that we are witnessing an episode of irrational exuberance or rational exuberance? If there was a steep correction, provoke
So I don't comment on the appropriateness of the level of stock prices. I can say that by some valuation measures, they're in the upper range of their historical value range. But I wouldn't want to speculate about what the consequences of a market correction should be. We would look very carefully at the nature of it. And it really what hurts is if consumers are borrowing heavily and go against, for example, an asset that can fall in value. So that's a really serious matter when housing bubble, highly levered housing values falling. We know that that's a really simple drop in equity prices all by itself doesn't really have those features. It could certainly affect consumption and have a negative effect on the economy, though.
Chairman Mark Hamrick with Bankrate.com. One thing that's changed, of mortgages last year came from so-called non-bank lending as traditional banks scaled back. What confidence do you have about the role of housing finance?
It's a good question. So you're right that a lot of mortgages are now originated outside the system. Many of those, though, have to meet certain basic standards to be bought by the GSEs. I think if we look at mortgage credit more broadly, though, what we see is that credit is pretty widely available to people with high
It's more from my
scores
side. The
and with
Trump
good credit,
administration
good
wants to
credit
tackle
records,
certain Japan
and
goods,
much
tariffs,
less available
and
than
other
it was
obstacles to
before the
trade in the next few
crisis
months.
to people with low scores and perhaps troubled credit history. Have we got that exactly right? I don't know, but that's the reality. In terms of those institutions, they do have supervision by the CFPB and other state regulators. But you're right, they're much of the origination process is outside the
This is
banking
the
system.
end
It's
of
something we
the
monitor.
Kyle's press conference.
Okay, well, I mean, these were legit. I got some good favorable ticks on these. They came back to my entry. I took almost zero risk on all of these trades, so they were great trades that just didn't make money. That's okay. We can do better, obviously, by taking the +3. But hey, I mean, think about it. We're in like pretty crazy FOMC action, and to have only ever had one tick of risk against us during this whole time is really quite amazing. So, even though I'm really pissed, well, let's close. What's with their music now? Good grief. I don't know. Like, I feel like sometimes in the past I've been a little bit too accepting of failure, I guess. Like, now I feel mad. Like, I want to win. I want to do good. But you also have to look at that and take the wins out of it. Don't you think? So, I don't know. I really want to start picking up some good runs again. I think that I'm a much better trader now. I mean, there's some indications that, in some places where I would have done poorly, I've done good and so forth. So we do need to maybe have a little bit more, hang on a little bit more when it actually gets moving. So, I don't know. That or we got to take the 3. So, it sucks. I don't know if there's any comments. There are probably not very many people watching anymore. Nope. But that's okay. Good view. Alright, guys. Well, I will see you guys tomorrow.